Hello everyone. Today we are going to unravel some common myths about dividend stocks that often lead to confusion among investors. One of the most prevalent misconceptions is that dividends are essentially free money. Let's clear this up. Dividends are actually a portion of company's profit paid out to shareholders. When you invest in a dividend paying stock, you are not just buying a piece of paper or a digital number in your portfolio. You are becoming a part owner of the company. And as part owners, shareholders are entitled to a share of the company's earnings. But here is where it gets interesting. These dividends are not just like came out of thin air, right? They are distributed from the company's earnings. So when a company announces a dividend, it's using its profits to reward its investors. Now let's address another one more critical point: the stock price adjustment post dividend distribution. Suppose a company stock is say trading at rupees 100 and it announces a dividend of 5 rupees. And the ex dividend date, the stock price often drops typically by the amount of the dividend. And why this happen? It's because the dividend payout reduces the company's retained earnings, impacting its overall valuation. So sometimes you may get 5 rupees or you may get 4 rupees of the 5 rupees and 1 rupee will be taken by the company. So this drop doesn't necessarily mean a loss in value for investors. If you hold the stock, you receive the 5 rupees dividend, but the stock price reflects this payout by adjusting downward. It's a transfer of value from the company to the shareholders. So not a magical increase in wealth. So understanding these dynamics is crucial because it shapes how we perceive and evaluate dividend stocks. It's not about chasing free money, but about understanding a company's ability to generate profits, share those profits with its shareholders. So next time you hear someone say that dividends are free money, remember it's more about the companies sharing its success with its part owners. So that is you and me, the like investors. And when you see a stock price drop after a dividend payout, remember it's not a loss but reallocation of company's value. When you invest in a company that pays dividends, you are given a powerful choice what to do with those dividends. So, this choice is what sets dividend investing apart and caters to a broad spectrum of investment strategies. So, first, let's talk about reinvesting dividends. So, this is a popular choice for those focusing on compounding their investments over time, long time. By reinvesting dividends, you are essentially using your dividend payouts to purchase more shares of the company, which in turn might lead to more dividends in the future. It's a cycle that can significantly boost the growth of your investment portfolio. Especially if you are in it for the long haul, you are you are the key person going to get the benefits. On the other side of the spectrum, dividends can serve as a steady of income. So this is particularly appearing very interesting for the retirees or those seeking a regular income from their investments. The beauty here is the predictability and stability that dividend income can offer, unlike the potential volatility in stock prices. So why is this flexibility so important? Because it empowers you, the investor, to tailor your investment strategy to your personal financial goals and your life stage. Whether you are looking to grow your portfolio or seeking a steady income, dividend stocks offer a pathway to achieve your objectives. In essence, dividend investing doesn't just look you into a single strategy. It opens up a world of possibilities. It's about having control over your investment returns and using that flexibility to align with your personal financial journey. So whether you are building up your nest egg or enjoying the fruits of your investments, dividend stocks give you the power to choose your path. Just to sum it up for this particular thing, the flexibility offered by dividend stock is not just a perk; it's a strategic tool that can shape your investment journey. It's about making your investments work for you in the way that best fits your life and goals. Whether you are reinvesting to grow your portfolio or using dividends as a reliable income source, the power lies in your hands. So let's begin with growth stocks. So these are the darlings and everybody's favorite in the stock market, often associated with high flying tech companies. They are known for their potential to deliver significant capital appreciation. So think of the companies that are rapidly expanding, innovating, or entering into new markets. So investing in growth stock is like a riding a wave. It can be thrilling when the market is up, but it requires a stomach for risk during downturns. The key with growth stock is patience and timing. Your returns come primarily from the increase in the stock's price over the long time. It's about buying with the expectation that the stock will grow faster than the market average. Now let's shift our focus to our dividend stocks. So these are typically well-established companies, the history of distributing a portion of the profits back to shareholders. So investing in dividend stock is like having a steady and reliable income stream. They may not offer the accelerating heights of the growth stocks, but they provide a sense of security with their regular payouts. So dividend stocks are particularly appealing to those who need consistent income. So they are also a great way to reinvest and compound your earnings as we discussed earlier. So which is better? The answer is not straightforward. It depends on your investment goals, risk tolerance, and time horizon. If you are young and willing to take more risk for potentially high returns, growth stocks might be the more appealing one. But if you are looking for stability and regular income, dividend stocks could be your go-to. But here is a thought: why not have both? A balanced portfolio can include both growth and dividend stocks. So this way, you can enjoy the potential high returns of the growth stocks, while the dividend stocks provide a cushion for your regular income. So in investing, there's no one size fits all approach. Whether you lean towards growth stocks, dividend stocks, or mix of both, the key is to align your investments with your personal financial objectives. Remember, investing is a personal journey. I keep on telling you this one. Choose the best path that resonates with your goals, and you will be on your way to financial success. So, first up, let's talk about the stocks like REC, PFC. So, these are not just any companies, they are pivotal in the power finance sectors in India. What makes them stand out as dividend stocks? Consistency. Despite the ups and downs in the power sector, these companies have managed to provide steady dividends to their shareholders. So this is a testament to their robust business models and their critical role in the Indian power sector. So moving to the tech giant like Infosys or HCL, so it's a household name in India's IT sector. Infosys has been a consistent performer not just in terms of business growth but also in rewarding its shareholders. This combination of growth and dividends makes Infosys a unique contender for those who are looking for the best of both worlds. In the retail industry, HUL is another heavyweight. It's a wide range of consumer goods, has been a part of Indian households for decades. But what's interesting for investors is HUL's track record of regular dividend payments. It's like owning a piece of company that's integral to your life, everyday life in India, and getting rewarded it regularly. Lastly, HUL is another heavyweight in the FMCG sector. Its wide range of consumer goods has been a part of Indian households for decades. But what is interesting for investor is HUL's track record of regular dividend payments. It's like owning a piece of a company that's integral to everyday life in India and getting rewarded for it regularly. Lastly, ITC Limited, a diversified conglomerate known for its presence across industries like FMCG, hotels, paperboards. ITC has been a favorite among dividend investors for its high dividend yield and consistent payout history. So this makes ITC an attractive option for those seeking income along with exposure to a diversified business. What is this dividend yield? Dividend yield is normally calculated by the dividend given divided by the current price or the close price of the market. So that is how the yield is calculated. So when the price grows, your yield may go down. So why consider these companies for your portfolio? It's simple. They offer a blend of stability, reliability, and commitment to shareholders' returns. Whether you are looking for a steady income stream or a way to balance your high growth in investments, these companies could provide the anchor you need in your investment journey. It's not an investment advice, it's a few stocks I mentioned, but I will guide you how to pick the best dividend stocks in few minutes. But dividend investing in India is not just about picking any high dividend stock, it's about choosing companies like REC, PFC, Infosys, HUL, ITC, which have not only a history of consistent payouts but also a strong business foundation. Remember, in the world of investing, stability and consistency are valuable as growth. So let's see the how to find out the dividends plus growth stocks in this one. Okay. So as I mentioned, so this is the ticket. So you can add your own screeners. So for specifically for this dividend plus growth is what we are going to look at. So let's go step by step. So since we are going to look for dividend, so I need to see like last 5 year growth. How was the 5 year revenue growth and how is the 5 year CAGR? So two are important parameters. So then I want to see the net profit margin. I want to see last 5 year net profit margin and the current net profit margin. Okay. Then the main thing is the dividend. So last 3 years, how much the dividend yield is improved and what is the dividend yield and dividend per share, how much you are expecting. And so these are the main parameters. So let's go step by step. Now going to the market cap, I want at least 10,000 crore. I don't want the small companies, actually at least I need 10,000 crores. And last 5 year, the revenue growth, at least it should have grown by 10%. Okay, we got 290 now. Then last 5 year CAGR, again I need at least 10%. And net profit margin, let's say that also at least it should have one profit margin of 10. And the recent one also I want it in the positive side, I don't want the negative one. And every year how much the dividend is growing, so at least it should grow by 1%. So I'm going to have 1. And what is the dividend yield? At least it need 1%. Dividend per share, at least I'm looking for 3 rupees. So now we got 20 results, if you see. So these are the growth plus dividend, better dividend yield stocks. If you see TCS, Infosys, HCL, LTI, REC, Sriram Finance, Muthoot Finance, you can see all these are good stocks which are giving a good dividends. Now hope you understood how to pick the dividend stocks. This is how you have to pick. The stock market is inherently volatile. Prices can soar or plummet based on a lot of factors, from global events to company specific news. For many investors, especially those who are risk averse, this volatility can be unsettling. Here is where dividend stocks come into play. Unlike stock prices, which can be unpredictable, dividends tend to be much more stable. Companies with a history of paying consistent dividends are often well established and financially sound. So they generate enough profit not only to sustain their business operations, but also to share their earnings with shareholders. So let's consider a scenario. Imagine the market takes a downturn and stock prices across the board start falling. For investors who relies solely on stock appreciation, this can be worrying. However, if you hold dividend paying stocks, you have a cushion. Even if the stock price drops, the dividend payout often remains unchanged, providing a steady income stream despite the market turmoil. So this stability is crucial for certain types of investors. If you are planning for a retirement or looking for a regular income from your investments, dividends can be your friend. So they provide predictability and sense of security. So that is hard to find in stock markets ups and downs. Moreover, incorporating dividend stocks in your portfolio can be excellent way to diversify and manage risk. While growth stocks offer the potential for high returns, they come with higher risk, especially in volatile markets. Dividend stocks can balance this out, offering a more predictable return. In conclusion, dividend stocks can be a haven in the often turbulent waters of the stock market. They provide a source of income that is less affected by short-term market movements, making them an appealing choice for the risk-averse investors or anyone looking to add a layer of stability to their portfolio. Remember, a well-rounded investment strategy often involves a mix of different types of stocks, and dividend stocks can play a key role in that mix. Alright, before we wrap up our discussion on dividend investing, there's a crucial piece of advice I want to leave you with. Not all dividend stocks are created equal, and a high dividend yield is not always a sign of a good investment. Let's get one thing clear. A company offering high dividend may not always be for the right reasons. It's essential to dive deeper and understand why they are able to give out such generous dividends. Sometimes it could be a red flag rather than a green light. Investing in blend of dividend and growth stock is not a straightforward task. It takes a keen eye and a strategic approach. Sometimes companies may not offer dividends at all, arguing that reinvesting profits fuels their growth, which in turn could lead to a higher stock price. But here's the kicker. You can't lock your money away indefinitely. hoping for the right moment to sell. Market timing is a notorious challenge. Selling too soon or too late can lead to regret, especially if stock prices continues to climb after you have exited. That's why having a stock portfolio that pays consistent dividends can be a game changer. It provides you with a steady cash flow, giving you the freedom to plan your finances with more certainty. Don't just follow the herd. It's not wise to dismiss dividend stocks as inferior investments. Take companies like PFC and REC Limited. For instance, they have seen significant growth over time, and they have been through periods when the stock prices were incredibly low, a potential opportunity for mindful investors. I have personally experienced this. During a time when the prices hit rock bottom, I chose to buy and hold these stocks in my port. That decision were based on careful analysis, not impulse. It's about breaking the myth and approaching your portfolio with a mindful strategy. So here's my parting thought. Don't rush into dividend stocks without understanding the full picture, and don't write them off just because of market hearsay. With a mindful approach and thorough analysis, you can build a portfolio that not only grows but also provides a steady income through dividends. Remember, your investment journey is unique. Plan wisely, invest mindfully, and create a portfolio that aligns with your financial goals and timeline. Thank you for tuning in, and let's continue to make informed investment choices together. And I mentioned earlier, I have published a book. I'll leave the link over here. Do read the book and provide your feedback. And don't forget to subscribe my channel, press the like button, and don't forget to press notification icons. If you like this video, do subscribe, do share it, and do share it with your friends and colleagues. And finally, happy Pongal and happy Makar Sankranti. Thank you.